If you're in shares or crypto, you got to hang on to your hat because it's going to be a wild roller coaster because they're going to be going up and down like a roller coaster. It's going to be doom and gloom, and then it's going to be exciting. It's going to be good and bad. It's going to go all over the place. I'm not a fan of gold because with gold, it's hard to move around. It's heavy, but also you're not getting any rent. Like it just sits there. And it does go up in value, yes. But with property, you're getting rent and you get appreciation at the same time.
And tax
So
deduction.
yeah, exactly. So you don't get tax deductions on gold at all. The financial planner was telling her, don't get a property in super, put it in the share market. But she got a self-managed super fund, got a property in super, and she's made how much equity in only a couple of years?
Oh, over 200,000.
Over 200,000. I'm a big fan of low cash rate. I'll tell you why. If you've got a low cash rate, gives you the ability to leverage more and get more investments and make more money. Whatever you're making in the bank, let's say the banks give you 10% return, if it's really high, that means inflation's 12%. You're always losing money on your money in the bank. They never give you more than inflation. They give you less. They give you a discount.
A lot of opportunity.
Yeah, totally. And look, that gap's gonna close over the next 20 years, right? I think it's going to take about 20 years.
The clock is ticking. You've got 20 years.
Yes. Okay, guys, me and my team are about to go live. So make sure you grab your beverage of choice, sit down, and you're in for an amazing show. Hello, and hello to the weekly Money for Life Mastermind. This is where we talk about money for life and how to create it. The home of street smart investing. Welcome. So what I'm going to do today is I'm going to do a bit of the state and nation and tell you what's going on at the moment. There's a lot going on at the moment when it comes to property. And then I'm going to be talking about our 2-day workshop that's coming up in September. And after that, we're going to go into our private group and we're going to be talking about what everyone wants to do. I've got some exciting stuff because I've spoken about this before and I'm going to announce it tonight and I'm doing it. So I'm going to do it in public so everyone knows that I'm going to do it. So
Awesome.
I'm going to be announcing something to keep myself accountable.
Even I don't know what he's going to say, ladies and gentlemen. It's going to be a surprise to me too. So
welcome to our Thursday Night Live. Okay, so the RBA is warning of the housing super cycle because the latest pricing from the internet rate futures market has the official cash rate falling to 2.9% by year's end, right? Which means they're suggesting another 5.25% rate cuts this year. So everyone's predicting 5 rate cuts. And I'll tell you what's pushing it. What's really pushing it is actually our orange friend in America, Donald Trump. Right? He's been driving it. Now, one thing for sure, next 4 years is going to be very exciting. And you don't want your investments to be exciting. That's the problem, right? And put it this way, if you're in shares or crypto, you got to hang on to your hat because it's going to be a wild roller coaster because they're going to be going up and down like a roller coaster. It's going to be doom and gloom, and then it's going to be exciting. It's going to be good and bad. It's going to go all over the place. But the beauty of it is if you're in hard assets like property, then you can actually capitalize on the uncertainty and make money. Because what happens is when there's uncertainty in the marketplace, money leaves crypto, it leaves the share market and goes into property and gold. That's the two sort of safe havens. So gold is an all-time high at the moment, and they're starting to open up mines. So what happens is when gold goes up in price, some mines that weren't really profitable suddenly become profitable. So they open them up again because they can make money. And so when gold goes up, the supply of gold goes up as well because it's worthwhile getting more gold, creating more gold. They actually create more. Now, as you know, I'm not a fan of gold because with gold, it's hard to move around. It's heavy, but also you're not getting any rent. Like it just sits there. And it does go up in value, yes. But with property, you're getting rent and you get appreciation at the same time.
And tax deduction.
Yeah, exactly. So you don't get tax deductions on gold at all. Right. So they're predicting 5 rate cuts. So the RBA And what a super cycle is? A normal cycle is around about 7 or 10 years where property doubles, right? A super cycle is where that's extended out and much higher and much greater. So, normally you look at properties doubling every 7 to 10 years. The RBA is saying it's going to get bigger and bigger than that. Now, look at this. Home values typically rise whenever interest rates are cut because that reflects the increased borrowing capacity and lower repayments that arise from rate cuts. And you look at this, you've got the RBA cash rate down the bottom and Australia dwelling prices growth and RBA cash rate. Now, look at the graph, and you can see usually when that graph goes up, monthly household price, the RBA is going down. So they're sort of opposite.
Yeah, we
right?
had a good question here, George. Is a super cycle a short period of growth?
No, it's a long period of growth. So so what happens is normally over a 10-year cycle, you've got properties going up for a little bit, then they're flat, and then they correct. But what we're looking at is a longer growth cycle, much longer.
So they're just going to keep growing up over a longer period of time?
Yeah. Yes, that's right.
Nice. When was the last super cycle?
Well, look, we haven't stopped. So what happened was pre-COVID, we're doing really well. COVID, we did really well. Post-COVID, we've done well. Property prices have been going up consistently for like 10 years in a row. You look at all the properties we've got for our clients. Year after year, everyone's making so much money. And I mean, a real good example, if you want to go through, because we're going to do a case study next week, but if you want to talk about one of our staff members who joined that program, what they did with their super, and do you want to talk about that?
Yeah, I was going to do a proper case study.
No, I get that, but what I want to say is the financial planner was telling her, don't get a property in super, put it in the share market. But she got a self-managed super fund, got a property in super, and she's made how much equity in only a couple of years?
Oh, over 200,000.
Over 200,000. Now, if she had it in super of what happened recently, she would have lost 100 grand.
Yeah.
Right? Not made 100, not made
Yeah.
200, because that's how volatile it is. So you got to be careful who you listen to. You know what I mean? And you really want to listen to someone that actually knows what they're doing and someone that's got experience at doing it. That's the important thing, right? So compare the market estimate that a graduate home buyer with a pre-tax income of 75,000 would be able to borrow 26,000 more under the lending standards range, right? Where a home buyer with 125 pre-income tax would be able to borrow $95,000 extra. So what's going to happen? People's borrowing capacities are going to be going up. So if you're concerned, if you've been crying about your borrowing capacity or staying up late at night, the RBA is saying your borrowing capacity is going to go up very soon and quite significantly. Because you look at this, the borrowing capacity is going to go up quite a bit. Look at this. Sydney house prices passed the $2 million mark. On the 15th of April, for the first time in history, they've hit $2 million.
That doesn't surprise me.
Yep. Right. So according to Domain, the actual median sold price of Sydney houses was a record 1.65 million in fourth quarter of 24. So with the cash rate, they expect the cash rate to be 2.85% by the end of the year. Now, that's awesome because me personally, I love a low cash rate. I'm a big fan of low cash rate. I'll tell you why. If you've got a low cash rate, it gives you the ability to leverage more and get more investments and make more money, right? When the cash rate's high, it's terrible. Funny enough, you get people that aren't educated, right? Financially educated. And I remember when the cash rate was really high and people were putting their money in the bank going, wow, I'm getting all this percent in the bank. They don't realize that whatever you're making in the bank, let's say the banks give you 10% return, if it's really high, that means inflation's 12%. You're always losing money on your money in the bank. They never give you more than inflation. They give you less. They give you a discount. So if you're getting 15% in the bank, you're losing money. But it looks like you're making money because it's a high interest rate. But people don't get that. So they reckon by 2060, Sydney's population is going to be over 8 million people. And what's happening, all the young people are leaving Sydney or renting, and immigrants are replacing the Sydney people. because they can't afford it, right? So you look at actual at the moment, right? So at the moment, 30% of properties in Sydney are actually apartments, 40% townhouses, 55% detached houses. By 2057, 50% of properties in Sydney will be apartments. And this
Wow.
is just because they've got a ballooning population, detached housing will become increasingly scarce, replaced by apartments, which is going to drive up its value. I didn't realize you can see my laptop in the screen. Let me move this a little bit. Let me just put this up a little bit. Here we go. That's better. Otherwise, it's not good. Okay. So only 41,900 dwellings commenced in construction in Q4 2024, which is 30% fewer than Labor's target. Because what we need to build 30,000 homes to be built every quarter to keep up with Labor's target. And so just that last quarter, we're 18,000 houses short. Now you can imagine 18,000 dwellings, that's a lot of property that we're short. And this is just to keep up with demand. It's not even to oversupply. That's how short our supply is. Our supply is so short, that's another thing that's pushing the super cycle up. Yeah. The thing is, if you're looking at property now and you think it's expensive, wait a couple of years and look back and you're going to go, oh my God, that was so cheap.
Mm.
And that's
So
the thing.
the blue line is units and apartments. The red line is houses.
Yep.
And the black line is the total.
Yep.
Yeah, wow.
Well, in commencements, and they've gone right down.
Mm-hmm.
So only 168,000 dwellings commenced construction during the year, right? Which for the whole year, we were short 71,000 properties
Mm-hmm.
to meet the target, because Labor's got a target of 240,000 properties per year, and we're missing it by 71,000. Now, this is the problem. When you're missing the target, it accumulates, right? Because if you need to hit 240,000 every year, but you miss it by 70,000, well, then next year you need to hit 310,000, not 240. And then we miss that by 70,000. That means we're down even more. So it snowballs.
Keeps widening that gap.
That's right. That's right. So that's why people need to look at this and think, because you see people out there and they're looking at property and they're like, I'm not sure, and looking around and all that. The thing is, if you had a time machine and you went back 10 years, you wouldn't be saying that, would you? You know what I mean? You'd do whatever it took to get into the market if you had a time machine. The thing is, you've got a time machine now. The future is looking really bright for property. And that's what people need to realize. Yep. So migration's rebounding, but we're low on properties. So even construction, dwellings, approvals, completions, and you can see the target, and you can see the blue line where we normally are.
Wow.
And we've never hit that line in history, ever. We came close, 2015, back in the
Right.
good old days. But look at it now, after 2018. It's just like, we can't even get close.
Dropped off a cliff.
Yeah. And you look at dwelling completions versus population change. This is pretty amazing. That green is population change and dwellings right down there.
Wow.
This is actually the one graph that shows everything. You don't need to look at any other stat at all. You only have to look at this graph. All you're going to do is look at that red line and look at the green line. And while there's a gap between those two, that's a shortage of supply, and that's very powerful. Once those meet, then you've got a balanced market.
Mm.
What does that mean? Once they meet, you're going to make average returns in property, still good, but until they meet, you're going to make amazing returns.
Mm.
Right?
A lot of opportunity.
Yeah, totally. And look, that gap's going to close over the next 20 years. Right? I think it's going to take about 20 years.
The clock is ticking. You've got 20 years.
Yes, but you don't want to start in 20 years' time because you're going to
No.
miss all the growth, right? You'd rather in 20 years' time be a multi-millionaire out of property. But the fact of it is, this gap is really what it's at. Now, there's more to it than this because some suburbs are pretty average. Out of the 15,000 suburbs, some are really good. And the important thing is, once you know there's a big gap, let's find the suburbs that have got growth potential, not the ones that are going to die, because some suburbs die for many reasons. And that's what you want to do. That's the next part of the process, right? New home sales have also stalled. People aren't buying brand new properties because there's nothing to buy. And net overseas migration. So we had 155,000 people landed Australia in January and February 2025, the second highest number on record. That's a lot of people. And you look at our housing target, 240,000. You got these 155,000 people. Now, out of those 155,000 people, we need 50,000 dwellings on average. So they're taking up 50,000 properties out of the market because usually it's 3 people per property. Rent has gone up again. And what people are doing now is they're doing shared accommodation. So that's the news. And now I'm going to talk about something very exciting. We're going to talk about our property masterclass. So I'm doing something special, which is going to be pretty cool. So what we've got is between 5th and 7th of September, we're going to be doing a 2-day masterclass with our clients. So this is what I'm doing. I'm hiring out the Safari Zoo in Bali for our clients. And what we're doing is we're organising buses to take you there. We're going to have a private tour at nighttime with the zoo, and then we're having dinner with the lions.
Yay.
How cool is that? So,
Amazing.
yes, that's pretty cool. Now, before we finish the live, if you're watching this live in the group, I've got 10 tickets that I'm giving away to our event. So if you want an opportunity to win a ticket, type in #ticket, and my team will reach out to you and see if you qualify. Okay, so now we're going to go to the private group because we're going to, yeah, we're doing it. Why not?
That's cool.
I've said I'm going to do it. I'm going to finally do it. I'm excited. It's going to be great. Now we're going to go out of we're going to go into our private group now. We're going to talk about what we're going to be doing for the fun day. I'm going to get everyone to vote.
Amazing. Woohoo.